Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to go through a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship. We're going to be combining the financial statements together as if one financial statement. We will have a downstream and upstream sales taking place within the transaction. That's going to be the new thing that we will be focusing in on. Those downstream and upstream sales happening in the current year that we will be consolidating. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We got our information on the left-hand side. We're going to enter that into the blue area on the right-hand side where we have our worksheets, and then we have our consolidation worksheet all the way over here to the right. Let's take a look at our information going all the way back to the left. We say P purchased a percentage of voting common stock on January 1st, 2000 X0. Percentage of the stock was 70%, so they got a non-controlling interest. So it's a controlling interest, but it's less than 100%. So therefore, there is a non-controlling interest that's going to be there, the 30%. And the cost of purchase is going to be the 3017. The non-controlling interest fair value was 129,300 at the point of purchase, X0. The book value of S was 395,000. So at X0, assets minus liabilities, or the equity section, book value of the company, 395. Book value and fair value same except for, in other words, the assets and liabilities were all the same, except for the fact that the land was $14,000 higher at the point of purchase. So if we fair value everything, land, notice it's not a depreciable asset here. So we're talking about something that we're not going to have to deal with the depreciation issue, which is nice. Land was $14,000 different. Then on January 1st, 2000 X4, we're going to be doing the consolidation by the end of 2000 X4. P inventory included unrealized intercompany profits recorded by S of 42,000. In other words, in prior years, we're thinking 2000 X3 most likely, right? There was a sale from S to P, and so now P has got this inventory on their books of 42,000 as of the beginning of the year that we're currently going to be reconciling. That is showing, it's showing, or the amount included in it would be gross profit that was recorded by S when S had recorded this sale basically last year, because this is as at the beginning of the current year. All right. So then next one, January 1st, 2000 X4, S inventory included unrealized intercompany profits recorded on P book of 15,000. Okay. So now beginning of the year again. So now we're saying S has inventory on its books that represents something that was sold to it, inventory sold to it by P, the parent company, again, in the prior year. So in the prior year, then P sold to S. So you got this going both ways, right? So that, which is kind of confusing. So you would, and in practice, you would think that it might be a situation where the sales might be going one way and not the other, but they could be going both ways, right? It could be that the subsidiary is selling to the parent and the parent is selling to the subsidiary. And so we've got these intercompany transactions. So now we've got inventory at the beginning of the year on S's books that's representing gross profit because it's on the books at a higher amount than was originally purchased for by P, the parent company that sold it, to S. So we'll have to account for that. Both companies sold their ending 2000 X3 inventories to unrelated companies in 2000 X4. So now we're saying, okay, so that basically the inventories were then sold in the current year. So these beginning inventories we're saying that are on the books as of the beginning of the year that came from the related party were now sold in that year in 2000 X4. So then during 2000 X4, S sold inventory to P. So now we're talking in the current year. So now we're within the year that we will be consolidating, 2000 X4, we're saying that the subsidiary sold to the parent inventory. They sold it for the sales price, 75,000. The cost to them was 50,000. So P held all the inventory purchased from S during 2000 X4 at December 31st. So as of the end of the year then, the inventory that was sold from S to P with this transaction is still on the books of P. They didn't resell it to someone outside the organization. So remember, you're kind of thinking about this when we think about the consolidation as if they are one entity. So now you're going, okay, so now S sold it to P, recognized some kind of intercompany profit when they sold it to P, which is the difference between these two, and now P is still holding on to that inventory because they didn't sell in any of it, so no real profit was made between the two of them, and the inventory on P's books is now overstated because it's going to be on the books for the 75,000 when really, if you think of it as one company, it was 50,000, right? And then during 2000 X4, P sold goods to S, so it could go the other way around too, right? So now we're saying P, the parent company, also sold inventory or goods to S. So if that's the case, now we're going to say, all right, they sold it for 111, and the cost was 66.6. Does S still have that inventory, or did they resell it? So S still holds part of its purchase from P on December 31st. They still hold 37,740 of the amount that was sold to them. So they have resold part of it, but not all of it. Okay, so now we got to basically consider. Now we're going to name these things. We're going to start with the new stuff here. We're going to name these things basically downstream transactions and upstream transactions. So the downstream transactions are going to be the items that are going basically from P, the parent, going down to the subsidiary. That's how you want to think of, the downstream transactions. So we got the downstream transactions for 2000 X4, the current year that we will be working in on here. So let's think about these transactions first. Let's break these out. It's a little bit tedious to do this way, but it's worthwhile to kind of mull this over. So we're going to say, all right, the sales. We know in 2000 X4, I'm just going to pick this up from the data, we had P sold goods to S for that 111,000. So we're going to say, all right, there's a 111,000. We're going to say the cost of goods sold of those goods was 66.6. So the difference between those two is going to be 44.4. Now we could calculate the gross profit too, right? So if I take the percentage, the gross profit percentage, this number divided by this number, that's going to be 40%. Or we could take the cost of goods sold percentage, then would be the 60. This number divided by this number. So that's going to be the 60%. I'm going to make this a percentage as well. Now, we could think about this, okay, what does that leave us with in ending inventory? We might think about what ending inventory is and then back into the resale amount. Or we could think about the resale and then go to the ending inventory. Depends on the numbers that we have here. These are going to be related. So it told us here that we're going to say, all right, the amount that was resold on these was, they're saying the 37,740 were left. So what I'm going to do is I'm going to say, all right, well, if I go back up to the sales item, and if I was to take then, so what I'm going to do then is I'm going to say, okay, of the 111 up top, we resold, minus the amount that is still there, right, which is going to be the 37,740, means that we must have resold, we're going to say the 73,260. And then I'm going to say, okay, if the cost of goods sold, I'm just going to use the percentage, the 60%. So of the 73,260 times 60%, or you can think of, if they give you the gross profit, it would be 1 minus the 40%, right? So I'm going to say, all right, this times 60%. And then I'm going to say this minus this. That's going to be the amount of the resale, basically, for the sales, the cost of goods sold, and the gross profit. And then we're going to go down, okay, that means that the ending inventory, what's left then, is going to be this number, the 111, minus the 37, which again, you could have got that 37 by, that's this number here. And then if you got that 37, then you could back into this number if you wanted to do it that way. And then we got the cost of goods sold, which again, I could take that 37,740 times the 60%, or I can just take the same subtraction, and I could take the 66.6 minus the 43,956. And then the gross profit I could calculate as, subtracting these two out. And so I could say, or I could use, the gross profit percent, or I could subtract this minus this. Should be all the same number. But in any case, I'm going to just say this minus this. And you can kind of double check this with the gross profit percentage, which we would think would be the same. And so I'm going to say, all right, that's still the 40%. So that looks good. Now this looks a little confusing, but it's nice to set this up in a standard kind of way. So there's going to be like the standard kind of setup that we'll set up, and then we'll put this into our little table on the right here. And if we set this up in a systematic way, we could break this stuff down, you know, a lot more easily. Okay, so then we're going to say, now we're going to look at the upstream transactions. That means that we're talking about those transactions where S is selling to P now. So it's going from the subsidiary to the parent. And we saw that we had the, let's say, equal to 75 during 2000 X4. S sold inventory to P for that 75,000. And the cost was 50,000. So this is S going to P. If I subtract those out, we get the 25. If I calculate the gross profit, the 25,000 divided by the 75,000 equals the 25,000 over the 75. I'm going to get then the gross profit percentage, which I'll make a percentage like that. And then I'll do the same for the cost of goods sold, because that's useful sometimes, which is just going to be the difference, you know, between, to make these 100%. Okay, and then we're going to say that P held all the inventory purchased from S during 2000 X4 on December 31st. So how much was resold then? 0, because they didn't sell P. So P still holding on all the inventory that S sold them in that year. So there's no resale here. So I'm just going to say nothing happened there. That means that these numbers are just going to be the same. So I'm going to say this minus this. It's all represented in ending inventory. So ending inventory, this is the amount that's basically represented still in ending inventory on the books of P. So then we'll subtract this out. All right, so there we have that. So now we're going to take this information and we're going to start to construct basically our table up top, which we're going to standardize in this kind of format. So we're going to say, okay, I'd like to take the net income, and then I'm going to reverse the gross profit deferral down. I'm going to reverse the gross profit deferral up, and then we'll talk about the gross profit deferral down and gross profit deferral up. This will be kind of a standard table that we'll be using. I'm going to delete a couple of rows here. Let's move this up a bit. This should be like shown this way on yours. All right, and then we'll do the same for the ending book value. So in other words, we're taking the income, and then we're going to use this table, we'll try to standardize this table to get to the calculation, breaking out between the non-controlling interest, the parent company, and then the total to get to the income to be eliminated. And then we'll think about the same kind of thing on the balance sheet side of things, looking at the ending book value, basically the balance sheet side of things, and have these same kind of transactions, which is going to affect the book value. So we'll think about it from the income statement side, the activity on the income statement, and the balance sheet, the net asset side of things. Now that we have that, let's move to the table. Now what I've done is I've kind of highlighted some of the data over here so we can at least say, hey, look, I did something with that. We've included those numbers over here somewhere. So now that we have that, let's think about our information that we have in terms of P and S statements. So we're going to say, all right, we're going to do this consolidation for 2000 X4. So we're going to get the parent company information that they have thus far, and then the S company information just as we have seen in the past, and then we're going to total them up as we've seen in the past. That's going to be our first step. So we're going to say, all right, let's sum this up. This is as of December 31st, 2000 X4. We're going to go ahead and copy and paste this on down. Paste this on down. That's going to be our starting point. All right. Now that we have that, let's consider this information. Now, note, of course, if we're looking at S's information here, so we have S's information, assets minus liabilities. That's going to be the 461,000. That's going to be like the book value as of 2000 X4, which of course equals the equity, the 461,000 as well. So let's go back on over and say, all right, let's go to our little table over here. And as we go through our table, it might be useful to hide these cells. So I'm going to hide cells M to T. You don't have to do this, but it might be a little easier. Going to left click on M, highlight on over to T, let go, right click the selected area and hide those cells. Let's go ahead and hide those cells and check out what we have thus far. All right, so we're going to say that now we're going to break this information out. I'm going to start with the net income and I'm going to break that out between the non-controlling, the parent, and the total. So let me pick up the total first. What I'm talking about is negative of this 44,000, the income here, which is revenue minus expenses for S 2000 X4. So then we're going to say, then I'm going to break this out and say that, well, then the parent portion of that is going to be that times 80% or 70%, sorry, 70%. And then the non-controlling interest, you could subtract these two out, or you could say this is going to be this times, I'm going to use this practice using this percentage, 1 minus the 70% or 30%. So there we have that, and obviously these two then adding up to the 44,000. Now we're going to go through our information here. We got to reverse the GP gross profit deferral down. So we're going to take this information and I'm going to be picking this up, and I can put it in either category. I'm going to put it in the total here, and I'm going to pick this up from the 15 in our data. The 15 in our data saying on January 2000 X4, S inventory included unrealized intercompany profits recorded on P book of. So in other words, we're talking about S's inventory as of the beginning of the year. So that means the sale must have happened in the prior year from P to S. So P to S, that's why it's going to be from parent to subsidiary or down. So we're going to label it as a down transaction, reverse gross profit down. When it is that case, we're just going to put the entire amount in the P column. Next, we have the reverse gross profit deferral up. That's going to be this transaction in our data, or this item in our data. January 1st, 2000 X4 P inventory. So now we're talking about P's books as of the beginning of the year that we're going to be dealing with, included unrealized intercompany profits recorded by S. So now this is something on P's books, which was a transaction that must have happened last year. So it went from S to P, subsidiary to parent, therefore an up transaction. And so we're going to record this at the 42. And this one we then need to break out. We're going to break out in our table with the 70-30 split for the non-controlling interest and the parent. So I'm going to take that 42 times the let's say 1 minus times brackets 1 minus the 70%, and then we'll take that 42 times the 70%. And of course those two then adding up to that 42,000. Now we're basically going to go to the current information. So it's going to be the 2000 X4 that we put in here. So we have the downstream and the upstream. We're basically looking at these ending results here, the difference. So I'm going to go into the P's column once again, and I'll put it into the total first. So I'm going to say that this is going to be, and these are going to be negative. I'm going to put them in there as a negative number, or they're going to be decreasing the amount here. So I'm going to say this is going to be that 15,096. This is all going to be going into P's portion here. Then we're going to be picking up the bottom line down below, which is going to be the 25. So the 25 for the up is going to be negative of, I'm going to say negative of that 25,000, making it a negative number. This time it being broken out between the parent and subsidiary, the 70-30 split. So this is going to be that times the 70. And then we're going to say that this is going to be this. I'm just going to subtract them out this time. This minus this. So, or the 30%, however you want to think about it. And that'll be the 25,000. Now we're just going to sum this up, which of course means like this plus this minus this. So, and wait a sec, one last thing. Let's do that again. Yeah, this plus this minus this. Let's sum it up. So we're going to say equals the sum of, and we'll just pick these items up. I'm going to copy and paste it then. Copying and pasting it, just summing up right on across. Okay, so that's going to be the net income we've adjusted. Now we're going to do the same kind of thing on basically the balance sheet side of things. So I'm going to start with S's base net assets, which are assets minus liabilities. And what we're really doing is we're giving a basis for that first journal entry that we will make. The first journal entry usually is going to be based on kind of like this net income number, which we're going to adjust now to these numbers down below. So we'll see how that looks. This will all pull together in that first journal entry. Okay, so then the other side of that first journal entry is we usually take the net assets and break it out between non-controlling interest and the P's interest, which is going to go into the investment account. So this comes out to the 461, or total equity, of course, adding up as well to the 461. So that's going to be our starting point. So I'm going to say this is going to be equal to the sum of the assets minus the liabilities, our starting point, the net assets. And then we're going to break this out between the 70-30 split. So we're going to take that times 70% of that for P, then the difference, or 30%, for the non-controlling interest. So then I'm just going to, the filler is all the same. Here's the filler. I'm just going to fill up the same stuff. So I'm just going to say, I'm going to do it this way. This equals this number, and this equals this number. I'm going to do this kind of quickly because I'm just you could copy and paste it, but I want to use formulas here. So I'm just going to do it this way. And there we have it. Probably could do it faster or slower, but whichever way might be annoying to you right now. But anyway, we're going to sum this up. And let's sum this up this way. And then we'll copy this down. And there we have it. So this whole middle part here, in essence, same thing, other side, other half of kind of like the transaction or journal entry. You can think about it. Income statement side, balance sheet side. All right. Then I'm going to highlight, and then we'll just sum this up. So we'll sum this up and say, all right, there we go. And let's copy that on across. So there it is. So we said, all right, here's the net income. Here's kind of like this effect that we're going to have on the net income. Here's going to basically be the end that's going to be used in our journal entry. Here's the net assets. Here's the effect, same, effects happening here. Here's going to be like the end that we're going to be using in that first journal entry. So this will be coming into play shortly when we finally get to the journal entries, which is, I know you're waiting for them because that's the exciting part. So anyways, now we're going to do our book calculation. Let's do our calculation of the goodwill. So our normal calculation of the goodwill we've seen in the past, nothing new here. We're going to say this is going to start with the net assets at the point of purchase. So this was at the point of purchase, this 395. Then we said that the assets were higher due to the 14,000 in the land that was higher valued. Therefore, the fair value at the point of purchase, like 4 years ago or whatever, in 2000X0, and it's 2000X4 right now, 5 years ago, something like that, is 409,000. The non-controlling interest at that point in time was, they give us the non-controlling interest 129.3. So the subtotal, or the amount of the controlling interest, you would think then being the 279.7. So we're going to compare that to what was actually paid to see if there was any goodwill. We're going to say, all right, how much was paid then? How much did we pay? And it was 3017. That means that there's goodwill of what was paid minus that subtotal of the 22,000. So there's goodwill of 22,000 that we will have to deal with. Okay, so now we're going to unhide some cells up top. So let's go to column K, highlight to column U, let go, right-click the selected area, unhide the selected area. Now we have the equity method, and then we got our journal entries. So we're going to reconstruct with the equity method first. To do that, let's go ahead and hide these columns. We don't need these, so we can think about equity method transactions first. So I'm going to hide these going from Q to T, right-click the selected area. Let's hide those for now. Now we're going to do the fully adjusted equity method, which means basically P is going to be reflecting just normal equity method process here, but they're also going to be taking into consideration the adjustments that they know are going to take place basically within the consolidation, which are going to conclude all this crazy stuff that happened here, which will in essence include this column here. So we'll see that in our equity method. So if you think about, this standard setup and you kind of think about this standard process, then you can use that to reconstruct the equity method, and then you want to kind of mull over, get a better understanding exactly why everything's going on. All right, normal equity method. We're going to say investment account. So investment account, we're not going to record this. What we're doing is reconstructing, at least in the current year, part of this, and we shall get to this number exactly if we can reconstruct the equity method for the current year, all right? So we're going to say that the investment account usually goes up. That's the first thing that we would think would happen. And the income goes up, income from S, for our portion, P's portion of the net income of S. So negative of that 44,000 down below times our percent, which is 70%, times the 70%. So there we have that. That's normal equity stuff, normally equity method-y stuff. And then you would think that they would have got cash. P would have gotten cash for the dividends that went out from S to P, and they would increase cash, and then the other side would go to the investment account. Again, normal kind of equity stuff. The dividends that went out were equal to or plus to the 6,000 from S. How many did P get? 70% times 70%, because they own 70%, so they got like that many dividends, or that's the amount of, okay. And so that's going to be the normal thing. Then we're going to go through this, and I'm basically going to look at this column, and take these items into consideration. These items into consideration. All right, so that's going to mean the first one's going to be a debit to the investment in S. So investment in S is going to be debited by that 15,000, and that's going to result in the credit to income from S. So that takes care of basically that one. And then we're going to say, then what happened? Let's move down to this one down below. I'm going to say, let's go to this one because we're doing the down and then the down. And this is going to be like the opposite. So we're going to say income from S and investment is going to be negative of that number. That's the debit and the credit. So there are those two. Then we're going to be considering basically these two are going to be taking place here. So that's going to be investment in S and income. And that's going to be the 29.4. And there we go on that one. So take care of that. That one's been taken care of, which is nice. And then we're going to do the other one, which is going to be a debit income from S, and investment. So again, you can kind of mull over exactly why this would be, but we're using kind of just the standard layout. So we got the standard table. If you set it up as a standard table, you could pull this up over in a standard way. And then again, you want to just kind of think through this more and more and understand exactly why it'll work that way. So we can do it systematically and then reason it out for yourself. Okay, so then I'm going to say this is going to be the 17.5 and the 17.5. So then if I was to add this up, so I'd say, all right, well, what does that do then? So on the investment side of things, what would have happened? We would have said, okay, so that means with this one, change the investment, this changed the investment, this went to 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 the investment. And then on the income, this changed the income, and this changed the income, and then this changed the income, and this changed the income, and this changed the income. And you can see that 42.6 will tie out to the 42.6 here. So we've reconstructed that. When we do the elimination entry, that needs to go to 0. If we have problems, we can kind of use this deconstruction to figure out, all right, how do I, what am I missing? And then this needs to go to 0. This doesn't match, of course, what we have here because this number is a balance sheet account, a permanent account. It goes back to 2000X0, 5 years ago, but we can at least see what happened in the current year, which we can be fairly certain of that we did correctly given the fact that this number is correct. Okay, so now let's unhide some cells up top. I'm going to highlight from 0 or O to U and OU. I don't know OU, and then I'm going to right click on the selected area and then unhide. So we'll say unhide. So there we have that. There. Now we're going to actually get to our journal entries finally. This is the amount, this is the time like we've been waiting for. We're going to start off with the normal type of journal entry. So we know journal entry, we know this needs to go to 0 at the end of the day. We know this needs to go to 0. So those are two things that are happening. We know that these equity accounts for the S subsidiary basically need to go away. So let's start to reconstruct this, and this is where our table over here will come into play. It's gonna be great. So then I'm going to say that the investment account, I'm just going to start with that just because I typically do. I'm not going to put anything into it yet. And then I'm going to remove the equity section for S. So let's do that first because that's the same. So I'm going to say this is the same stuff. I've seen this before, and I like doing stuff I've done before because I know what I'm doing. So I'm going to take those three, and then I'm going to remove these items. Let's total it up first since we should kind of get ahead of myself here. Let's total up. So we've got the column for P, S, let's go ahead and total them now. So here's the total, as we've seen in prior problems. And then we're going to copy that, and I'm going to paste that down. There we have it. Now we're going to remove basically all of S's stuff here. We're going to gut S's equity. Gut S's equity. So this is a credit, so we're going to debit it to gut it. So I'm going to say this is going to be a negative of this. See, if it was a credit, we'd be putting more stuff in there, and we're trying to take this stuff out. So, and then we're going to take this, and then the dividends are a debit, so we're going to credit the dividends. let's go ahead and just record that as we go so we can get familiar with what we've seen before and just say, all right, I'm still confident on this. This plus this equals that. I'm going to say this. Let's remove that then. So this is P's, this is S. Here's the total. We removed S to get back to P. Retained earnings. So we have the retained earnings here. We're going to post it. That means we had P's, we had S, we have the total. We removed P's to get back to S. Dividends. Same thing on the dividends. So I'm just going to record these as we go. Here's P, here's S, total, removed S, getting back to P. The other accounts we know are going to be affected is going to be this income from S is going to be a factor, and we know we're going to have to deal with this non-controlling interest in S, and we're going to have to deal with the non-controlling interest for the balance sheet and then the income statement of the net assets. These are all the accounts that are affected. Now, normally, we would say that this number would be our percentage of that 44,000, 70%. This number would be the non-controlling interest of that 44,000, or the 30%. This number would be the non-controlling interest of the net assets, which would be the 461,000 times the 30%. And this would be the non-controlling interest, or the controlling interest of the net assets, which would be the 461 times the 70%, right? But we're gonna do that kind of from the table now. So now you can see the table. What we did is we took that 44,000 over here, which is the net income from S, and we broke it out then between the non-controlling interest and P and adjusted for these adjustments that we took place. So now we're going to use this table to construct our journal entry. So instead of just taking the 44, and we'll do this a little bit different in a future presentation just to see how it's, how you could see it a different, some different ways. But that's why we did this table here. So now we got the table, and we're going to say, all right, now this number then, the income from S, instead of just taking the 44 times the interest, I'm going to take the amounts directly from this table, the 42.6. That's P's portion, right? And then S's portion is going to be the non-controlling interest, which is the 18.3, instead of just taking the 44 times the 30%. And then instead of taking the net assets, just the 461 times 30 and 40%. Here's the 461, which we then broke out once again after adjusting his entries. So therefore, we're going to take it from this table again and say that this is going to be equal to, I'm going to say negative of this 143.4. And this number then is going to be breaking out the other side, right? This is going to be the negative of the 334,504. So there we have it. So and if you highlight this whole thing, that's going to be the 447,904, which is this 447,904, which we basically broke out between a 30-70 split, right? Between P's portion that was in the investment due to the equity method being used and the non-controlling interest here. So that's going to be, the meat of it. A lot of what we've seen in terms of the creation of this table, the kind of the new stuff that took place. Now let's do some of the stuff that we've kind of seen in the past. One is we're going to say, all right, the other thing that's going to have to happen is that we've seen this in the past. The assets, these depreciable assets, are higher because land was higher. We don't have to deal with depreciation, but the land needs to be recorded because it's got to be increased on S's books here. Okay, so we've seen that in the past. I'm just going to say, all right, so the depreciable assets need to be going up, and they're going to go up by that, I think it was the 14,000 we saw right here in this calculation, the increase in the fair value at the point in time of purchase. We also have the goodwill that we calculated right here that's going to have to go on the books. So I'm going to say, and then goodwill, going to add goodwill. And this is stuff that would be repetitive. Like 5 years out, we would have seen this from year one. It's not something, so this would be stuff that should be able to roll forward. We're like, there's the goodwill. Got to put that on the books when we do the consolidation thing. And then these are two basically balance sheet type of accounts. So we're going to break them out between the two balance sheet accounts for P and S. One, the investment account for P, because it's been recorded already in the equity method, and the other being the non-controlling interest for the balance sheet side of things, which is the NCI for the NA, the net assets, rather than the net income NCI. All right, and then we're just going to break this out between a 70-20 split. So I'm going to do that this way: negative sum of these, close up the brackets, times, and I'm going to bring out the 70% here, and then I can do the same thing. I could just do the negative sum formula, but I'll use the percentage just to emphasize this. Negative times, and I'll say 1 minus 70% or 30% or whatever. It's the plug. It's what you need to be in balance. But I like to just emphasize that, right? So that should put us in balance here. Now I haven't finished recording this, so maybe I should go back up here and finish recording this so we're in balance before I move forward. So that's probably a good idea. So then I'm going to say this equals this 334,504. So we're not at 0 yet. So we're not quite done with that yet. We did I recorded the common stock, this, and this. The income, let's go down to the income. So the income from S, let's record that. Then we have the non-controlling interest here. So let's record that. This equals that non-controlling interest. And then we have the non-controlling interest up top. Let's record that. That should put us back in balance. So we'll record that. Back in balance. Back in balance. Back in balance, and we can be in business when we're in balance. And then we got the depreciable assets. Depreciable assets are up top. So let's record this. This is going to be that 14. Then we've got the goodwill. Let's go ahead and record the goodwill. That's going to be the 22. Then we have the investment. So the investment, let's go up top and record that. I'm going to say F2 plus F2. Investment, 25. And then the non-controlling interest here. So I'm going to say, all right, there's that. Okay, so once again, I'm really hoping that these two accounts kind of go down. Let's make these our yellow-red combo. I like to make them our yellow-red combo because we're really concentrated on that one and this one. So we want both of those to be down to 0 at the end of the day. Next thing we want to consider is going to be the fact that we had these inventory items that were on the books. These items right here representing inventory on the books that were intercompany transactions as of the beginning of the year. So this came from here and here in our data, and in the data it basically says as of January of this year we had these amounts that were on the books as of the beginning of the year, and then of course we assume that we sold them in the current year. So if we sold them in the current year, we're going to say that there's cost of goods sold that's going to be in there that we're basically going to be eliminating. So we're going to be eliminating cost of goods sold related to these items. So I'm going to say, all right, let's think about that first. I'll put it on top, even though I'm going to credit it, just because that's what I'm going to think about first. So they're going to have the sum of cost of goods sold is going to be this 15 and the 42 that we're going to be eliminating. And you might think, well, why are we eliminating the cost of goods sold? Because we're going to sell it, in the current year. But notice if we sell it in the current year, the cost of goods sold is going to be what we purchased it for, and what we want to record it is the cost of goods sold that was actually the cost at the original purchase between either S or P when they originally purchased it. So we'll reverse the entire cost of goods sold, and then you might think, well, what about the sales item? We'll think about the sales item separately. So let's see, and we'll work this out and kind of mull this over. So we have the cost of goods sold. We're going to be breaking that out between the two components that we typically think about, one being the investment account, so the investment account, and the other being the income, the non-controlling interest in the net assets. And so notice we're kind of talking about a timing difference, right? We're talking about cost of goods sold that we're saying was probably recorded. It would have been recorded in the current period, an income statement account that we're going to basically remove to the balance sheet side of things. So notice we're using here the other side being the investment account, balance sheet, and the non-controlling interest, rather than basically the income account and the non-controlling interest in the NI. Okay, now you might think then I should take this and break it out between the 70-30, but no, we're going to use our table over here to break this out. So we're going to break it out in accordance with our table. And so we're going to say that this is going to be for the investment equal to, on the investment side, I'm going to say it's going to be this plus this P's portion. So that's going to be the 44.4, and this is going to be then the non-controlling interest, the 12.6. And so if the 12.6, and that adds up to the 57, which of course is these numbers we started with, the 57. All right, let's post that out, and then we'll move forward here. So I'm going to say, all right, cost of goods sold is here. Let's go on over to the cost of goods sold and record that. Then we've got the investment. That's going to be up top. Let's record the investment. I'm going to say F2 plus F2. Record the investment. And then we've got the non-controlling interest in A, the non-controlling interest. So I'm going to say F2 plus F2 for the non-controlling interest. So there we have that. Okay, so next we're gonna think about the revenue side of things. What do we got to do on the revenue side of things? In other words, we have sales happening over here, and we can think about, okay, like in the current year, we had the sales taking place. This sale, there was a downstream sale and this sale. So what we're going to do is we're going to be reversing those items. So I'm going to go back on over. I'm going to say, all right, well, revenue. I'm going to remove the revenue. I'm going to say revenue is going to be a debit to remove it. And I'm going to say that's going to be equal to these intercompany revenues that were recorded. That's going to be basically this number and plus this number. So that's going to be the downstream and the upstream for 2000X4, the current year that we're talking about. So that's going to be the 186. Then we're going to go to the cost of goods sold. And I would think about it this way. I'm going to think about, okay, the related cost of goods sold related to that would be the percentage of that, or 40%, or we could do it this way. The related cost of goods sold is going to be a negative of, I'm going to do this with two journal entries to do this. It's going to be negative of this 66.6 in our worksheet, the related cost of goods sold, and the 15,000. And that's going to be the, let's do that one more time, negative of something funny seemed to have happened. Negative of, I need to subtract them. It needs to be this minus this. So in other words, the 66.6 plus the 50,000, I want to make it a negative. So negative that, and that is the 116.6. And then the difference is going to be inventory. That's going to be the difference in this transaction. So I'm going to say negative sum of that is going to be the inventory. So I'm going to pick that up in the inventory. Okay, so I'm going to record that. I'm going to reverse the revenue. So revenue is going to go down by the 186. The cost of goods sold is going to be here. Cost of goods sold. I'm going to say F2 plus F2. That's the 1166. And then the inventory up top. Inventory is going to be equal to the 69,400. 69,400. Then I'm going to take the difference here. I'm going to say inventory. This is going to be basically our adjustment. Inventory here, and the cost of goods sold. And the cost of goods sold, I'm going to adjust it for equal to, it's going to be picking up the gross profit of the amount that is resold. The resale amount, which is going to be the gross profit of that 29,304. And if there was anything resold down here, there's not, of the 0 down here, no resale down here. And that's going to be the adjustment for the 29,304 for the amount that was resold. And if we record that, then we've got the inventory. I'm going to double click on the inventory plus. That's going to be the 29,304. And the cost of goods sold, I'm going to say plus and pick up the 29,304 there. All right, so there we have it. So that brings us to, if we look at some of our check numbers, we could say, all right, that's 0, that's good. That's 0, that's good. This represents the common stock that's on P. Looks good, looks good, looks good. We can also check the non-controlling interest here. That 18.3 should be tying out to our table at the 18.3 there.